Good morning, everyone. Welcome back, and thank you for attending our Investment Currents live event, our first call of the new year. I am Chris Briscoe, Vice President and Wealth Advisor for Girard, and joining me once again, Girard's Chief Investment Officer, Tim Chubb. We have another great call lined up for you today after a remarkable year and a lot of market-moving news in the final 3 months, but we do have our usual housekeeping items. First, you'll see some disclosures on the screen regarding forward-looking statements and how we reference Girard, so please take a minute to read through. And just a reminder, the presentation is being recorded, so if you can't stay on for the duration of the call, or if you want to watch this again in the future, please go to our website, meetgirard.com. The replay of the presentation will be available within the week, but there's plenty of information on the site that you might find helpful in the meantime. Also, as in past calls, we welcome you to send in any questions you may have. You'll see at the bottom right-hand corner Q&A of your WebEx window. All you have to do is click on the QA, enter your question, and we'll answer as many as we can at the end of the presentation. All right, and with that, new time, a little earlier today. Tim, let's get started. I'm going to send it right over to you.
All right, great. Good morning, everybody. Thanks, Chris. Welcome to our economic and market update as we start the new year. Yeah, a little bit of a different time. I'd say that it's unique for me to have coffee during our calls, which are usually at 4 o'clock, but that would be a lie. I've got some now. But as Chris mentioned, like prior calls, we'll start with really some quick update on market moves for the quarter that was, and then provide the broad assessment of the fundamentals of the economy that we believe will drive results in the year to come. And after our prepared slides, we'll open up the call for some questions, as Chris had mentioned. But again, before that, let's jump into market performance for the quarter. Despite a number of elevated and growing risks, and we certainly had a lot of headwinds over the course of the quarter, from the Omicron wave, the pivot from the Federal Reserve, inflation at a 30-year high, supply chain stresses. There certainly was a lot to keep investors concerned, but really we were still gifted with a pretty fabulous, Santa Claus rally to conclude a memorable year for the markets. Global equities moved to new highs in the final quarter as investors focused on the global economy returning to pre-pandemic levels and the ongoing support from the Federal Reserve and other global central banks. In the United States, large cap U.S. stocks, as measured by the Russell 1000 index, advanced by 9.8%, bringing its performance for the year up to 26.5. As measured by the Russell 2000, small cap U.S. stocks rose 2.14% for the last 3 months of the year and have gained nearly 15% over the last 12 months. The underperformance that we saw in small caps relative to large companies could largely be attributable to the expectation that investors that small businesses have a little bit more of a difficult time managing some of the rising cost pressures, both in labor and materials, that we've been seeing remain a present risk over the last 2 years. Taking a look at large cap sector performance, diving into the S&P 500 and the industry groups that make it up, and there are 11. All 11 sectors actually finished the year with double-digit gains, according to data compiled by Bloomberg going back to 2001. The S&P 500 energy sector was last year's biggest winner, although it's a very small percentage of the index, only about 3%, advancing more than 47% after being the worst performer in 2020 with a loss of more than 37%. The last time that all 11 sectors within the S&P 500 finished in the green was back in 2019. Overseas indices for developed international stocks, as measured by the MSCI EAFE, or Europe, Asia, and the Far East, rose by 1.48% for the quarter, gaining 5.47 for the year. And in emerging markets, the MSCI Emerging Markets Index actually fell for the quarter, down about 1.7%, and actually negative for the year, down about 4.5. And really, this was driven by the unexpected slowdown in China in the second half of the year, resulting from COVID outbreak, restrictive government actions affecting technology and internet sectors, as well as financial problems in their very important real estate sector after being hit earlier from some of the high-flying Chinese equities. The MSCI China Index was actually down about 20% for the year last year, and is a very significant contributor to the MSCI Emerging Markets Index from a performance perspective. In the fixed income markets, we saw modest returns, obviously very modest returns compared to equities and stocks, with the Bloomberg Aggregate Bond Index flat for the quarter, literally up 0.01%, so quite literally flat, returning negative 1.54% for the year. And lastly, we saw a lot of moves towards the end of the year, and really have seen that continue so far in 2022 within the Treasury market. The 10-year benchmark U.S. Treasury closed the year with a yield of 1.51%. It has already moved up to about 1.87 as early as this morning, which is higher. Obviously, to start the year, it was at about 0.9%. And we also saw short-term interest rates move higher over the course of the quarter. The 2-year rose up to about 73 basis points, or 0.7%, up from about 12 basis points, or about 0.1% a year ago, as the market began to price in some of the Fed action, especially during the fourth quarter. And just as a reminder, yields move inversely to prices, as you saw with the sell-off in the bond market. Yields moved higher in the Treasury market.
And Tim, inflation continues to be the top concern for our clients and us as well, and I'm sure the investment committee too. Since we last met a few months ago, we've seen a few inflation readings and a pivot from the Federal Reserve, in addition to other global central banks surrounding their view and approach to combating those issues. But why don't we start with a quick recap of how we got there and high-level thoughts from you and the team.
Absolutely. Yeah, and Chris, as you mentioned, inflation really is, the top concern of the investment committee, not just during the last quarter, but really for the bulk of last year, and it continues to be a huge focus of ours, headed into this year. And undeniably, inflation's here, given that vast fiscal expansion that we saw over the course of 2020 and 2021, leading to the explosive growth that we've seen and recovery we've seen, not just in the U.S. Economy, but the global economy as a whole. And at the end of the day, we really think it's naive to not expect inflation, to be a little elevated currently. And borrowing a phrase from Milton Friedman, inflation is always and everywhere a monetary phenomenon, at least in the short run. And I guess state it more simply, and not from an economist, which can sometimes be similar to what those predicting the weather at times. Inflation is normal and natural as long as it's stable. And so again, it's been definitely a challenging year, but one I think that we should all expect, and some of the effects lingering into this year. And so, in addition to this unprecedented fiscal boost, as we discussed before, we've definitely seen a significant shift in consumption take place from services to goods, where consumers have been snapping up more computers, electronics, appliances, furniture. As I think I mentioned earlier, we had a chair sitting off the coast of Los Angeles for quite a while, but and understandably, fewer hotels, airline trips, as we've had, certainly a lot of COVID-related concerns. And so, this obviously explains some of the large price increases that we've seen for goods like furniture, for example, and great deals to be had for travel and entertainment. And while we expect that trend to begin to reverse at the end of, and we saw that trend begin to reverse a little bit towards the end of 2021, the U.S. economy in particular is still consuming more goods than we previously have as a result of the amount of stimulus that's been again injected into the system, as well as low interest rates. And it's really exacerbated a lot of these supply side shortages due to production and logistic bottlenecks. And so the story is really one of a temporary excessive demand combined with temporarily restricted supply. And there was an article in Bloomberg published in October that had a chart suggesting that our major ports were seeing about a 20 to 30% more goods go through it than pre-pandemic. Just to give you some perspective of the significant increase in the volume that we saw, undoubtedly shrinking the logistics chain, even without the labor shortages and some of the other demand-related pressures that we've seen. One of the other things, last quarter and the year in the quarter prior, is a lot of retailers, very worried about getting, inventory for the holiday season. And so we saw a lot of ordering. November 7th, I think, was the deadline back in 2022, ironically close to, I think, the election from, but nonetheless, we definitely have seen, people ordering more, businesses, obviously to make sure that they're meeting demand of consumers. And as a result, it's contributed to some of the more bottlenecks, especially related to the ports, more so than we would normally expect, just given the expectations of having a challenging holiday season. And so, I guess, in summary, we certainly think there's a non-zero probability that inflation expectations will, continue to be ingrained in the consumer, as well as business leader psychology. And ultimately, this could become a self-fulfilling force that in the long run will actually lead to deflationary pressures. And so in other words, we expect consumers and businesses will eventually balk at higher prices, much like we saw with lumber prices, this time, or not this time last year, but about 6 months ago or so, with the expectation that they will normalize lower, presenting actually a headwind for growth. And so, the speed in which that occurs is certainly up for debate, but our base case is that we're very close, if not we've already seen peak inflation data here in the United States.
So let's take it a step further. We just had another reading last week from December, and it was fairly high. So walk me through how you and the team think about that series of recent inflation readings.
We just look at the headlines that are screaming inflation is not, at levels not seen since 1980s and call it a day. I'm obviously joking. There's a lot of fresh data that's been released recently, which has given us a really great glimpse into really what's driving this, inflation data. And I think it's so important to really look under the hood and understand what makes up, CPI, the Consumer Price Index, what makes up PCE. Maybe that's something you just want, our team to do, and us nerds who like to take a look at the basket of goods that make up these indices. But really, after with the November reading, we saw, as again the highlight, the headline suggests that CPI rose about 6.8% for the year, which was the highest 12-month increase since 1982. And unexpectedly, the December report showed CPI coming in at exactly 7% year over year, with core CPI, which strips out some of the volatile food and energy categories, 5.5%, which is still the highest in 2 decades. But again, looking under the hood, parsing through the data, the song continues to be the same in that the bulk of the strength in the underlying data primarily is driven by COVID-related supply chain issues, as I mentioned earlier. And that's a trend that gives us comfort that we will soon see inflation come off this peak and start to head south for the remainder of this year. And so just looking at a couple of categories, for example, apparel, we saw a substantial month-over-month increase of about 1.7%, but 90% of all apparel that we consume comes from abroad. And so obviously that has supply chain issues written all over it. Looking at transportation, which is also hot, up 2.13% for the month-over-month. Both used cars and trucks, demand related, new motor vehicles, parts and equipment, supply chain related. And so the data really is that noisy right now. And, headlines, stoking inflation. And we've, obviously have seen, so much concern from American consumers and our clients, about inflation. But it really doesn't simply capture the full reality of the situation that we're experiencing right now, nor the expectations of when things will, begin to moderate. So the last thing I mentioned, as far as, examples, shelter. So, where we all live has actually been not hot. In fact, it was quite the opposite, as I would imagine would be a surprise, to many. We actually haven't seen shelter prices, budge since September, and in the December report actually fell. And so, statistically, if we were to, try to, attempt to have 7% year-over-year inflation for the remainder of the year, we would literally need to see 6 straight months of month-over-month inflation prints of 50.5% or 50 basis points, to keep the annual rate at current level, which again we think is very low probability. And so, I think the big takeaway here is this is a one-time step up in prices, and a one-time step up in prices is not inflation. Inflation is a continued, persistent increase in prices, which is what I think the Federal Reserve has really been trying to say all along. And on the demand side of things, while we saw October retail sales actually be firm, November's retail sales were actually fairly weak, suggesting that Americans maybe started that holiday shopping earlier, as a lot of suppliers were attempting to get prepared for. And we saw retail sales actually fall about 2% in December, which was much worse than the forecast. And after excluding auto sales, fell over 2%. And so again, looking at the supply and demand dynamics of what's contributed to this inflation, we're seeing demand, begin to weaken a little bit. Part of that could certainly be as a result of, the COVID variant, putting more restrictions on, some of the hospitality and leisure sectors. But we also seeing consumer sentiment weaken as well, as many consumers are, afraid about inflation. And that, again, could be that self-fulfilling prophecy where people, tend to pull back their spending as they see higher prices prices move higher.
Right. So let's talk about the Federal Reserve and central bankers, as we know, have been reluctant to take action despite the risks of higher and longer lasting inflation. We know monetary policy support is ineffective in addressing, supply chain limitations, but I would argue that the monetary policy drives demand, contributing to the buildup of price pressure. So in other words, the Fed policy can't produce more computer chips, but it can slow future demand for them. Understanding that it's part of the Fed's dual mandate for price stability, how has what we're hearing from the Fed officials changed since our last update?
Yeah. The old adage, haste makes waste, was certainly taken to heart by the Federal Reserve, in the last I'd say 15 years or so, to some extent, but definitely was the case over the first 9 months of last year. And undoubtedly, the Fed really was forced to change, and making a sharp pivot within the last 3 months. And part of that, potentially could have had to do with, Fed Chairman Jerome Powell being recommended by the Biden administration for another term, just taking away some of the uncertainty. But, as you mentioned, following the FOMC meeting in mid-December, Fed officials announced that they were not only going to double the pace of tapering. So again, this is not buying bonds at the rate that they were, expanding the balance sheet, the quantitative easing that we saw now several times since the global financial crisis, and significantly so, following 2020. But they also signaled 3 interest rate increases for 2022. And obviously that forecast reflects, their greater sense of urgency from the Federal Open Market Committee to try to quell inflation. And so, on current course, we'll likely see the Fed balance sheet reach a steady state level, meaning they're not going to be expanding it, nor will they allow bonds to be running off of it. And so they'll maintain the level from within the balance sheet for a period of time. And reaching that milestone, no longer having quantitative easing, no longer buying bonds in the open market as they have, is a prerequisite for these interest rate increases. And now the median expectation from the Fed is actually, as mentioned before, calling for 3 rate hikes in 2022, and then another 3 rate hikes in 2023. And that's obviously a much more aggressive line than we previously expected, but it's been very quickly priced into the market. And candidly has been something that we've been very well positioned for as a firm. Again, this, raising rates and inflation, I wouldn't say this is a playbook, because there's certainly a lot of economic outcomes that we may likely see this year. But one thing that we felt, very certain about coming out of, the amount of stimulus and the low interest rate environment that we've been in, especially as the economy was performing well, is that we had to position more defensively for rising rates across our portfolios. And so, to your earlier point, the Federal Reserve is not alone. Most global central banks are poised to nudge policy rates higher, but it is really taking the foot off the monetary accelerator, not slamming on the brakes. It really is a moderation. So again, it's not not seeing the slamming on the brakes taking place, at least not yet potentially. It really is just taking the foot off of the gas. Again, moderating. And so our investment committee does not see the Fed responding extremely aggressively to the persistent inflation, as they may have in prior cycles with a series of rapid fire rate hikes that would have likely already begun at this point. And one of the most important points is that the sum of the rate increases matters, obviously a lot, and central bankers have learned of many lessons in acting too quickly within the last decade. And so we suspect the Fed will continue for the higher tolerance of elevated price pressures so that they do not derail an economic restart. But the way that central banks respond to inflation will be a very key story this year, and the risk of misreading the situation for 2022, in our opinion, is a significant one. And so we've continued to see treasuries, as I mentioned earlier, sell off in anticipation of a tighter Fed policy in 2022. Have continued to do so as we've started the new year. As I mentioned, the 10-year Treasury has moved closer to 1.9%, as again, the market is trying to be proactive in pricing in these policy decisions in the next 12 months and beyond. And so there are some Fed officials that have suggested that the Fed may be behind the curve on inflation, and they may need to raise short-term rates more in the near term. We've been hearing some rumors about maybe half a point or 50 basis point rate hike in March, which I think is unlikely, just given that the Fed has been very deliberate in the way that they're communicating likely policy decisions to market, so not to spook market participants. And so, at the end of the day, monetary policy and that, what central bankers are doing all day is not a hard science. And we believe it's very much prudent to account for the elevated risk of policy error this year. And so, while our view is that the labor market and the Federal Reserve will ultimately determine whether inflation pressures are persistent or transitory or not, as opposed to these temporary supply and demand dynamics. And so I think at the end of the day, if you're asking me to make a bet as to how many rate hikes we see this year, I think market participants are maybe fairly too hawkish, especially given how we've seen economic data soften in the recent weeks and months. I think we'll likely see, again, 3 rate hikes, maybe 2 to 3, as opposed to 4 or more. But again, it very much is, as you know, our colleague Mark Balser, who's our Director of Investment Strategy, gave the analogy the other day. It's sort of like Plinko. Once we start to see the momentum trending in one of the directions, the likelihood, that we'll see that quarter reach the other side of the board, I think, becomes much, much less. So.
Yeah, Mr. Price is right. Let's move on to the labor market, right? And the recovery in the labor market has been one of the bright spots of the past 2 years. We discussed in a prior call that job openings have recovered to 2019 levels within a year and accelerated to all-time highs about a year ago. How do you think about the labor recovery and how it could impact the central bank policy?
Yeah, and we really have seen record job openings. We've seen record low levels of labor force participation. And labor force participation is the percentage of population working or actively looking for work, which has really led to solid wage gains and obviously improved household income as more Americans have gotten back to work. And so, unlike prior recessions where household income tends to fall and then slowly recover over years, we experienced a totally different situation, coming out of 2020 and the COVID-19 crisis because of that stimulus, where total household wage income has fully recovered, even with fewer Americans in the workforce, and households took home more, saved more, and spent more than they would have without COVID. And the unemployment rate just recently was announced, fell to 3.9% in December, which is down 2.8 percentage points since this time last year. And fortunately, we've seen 4.5 million Americans finding employment last year, which is absolutely phenomenal. Great news for the American economy, but it could lead to inflation sticking around a bit longer. And so as labor markets show these tight conditions, similar to what we saw in the economy facing before the pandemic, all-time highs, in workers saying that jobs are plentiful, rising job openings, involuntary quits, and low layoffs, again, there's a lot of negotiating power for employees, and as a result, wage pressure, which flows through into inflation data. And so when I said earlier, what causes persistent inflation, it really needs to be driven from wage growth, although it's not one for one. If we have 4% wage growth, we're not going to have 4% inflation. It generally, for every 1 percentage point, contributes about 0.5%, in inflation. And so it's about 50% flow through. But we've really seen, high record, job openings really all over the place, not just in hospitality, manufacturing, and leisure, where, the job market was hit the hardest, coming out of the lows of the recession that we saw 2 years ago. We've seen in transportation, retail, business services, education, and healthcare. And as a result, hourly earnings, employment costs, have risen, 4 to 5%, which is close to the highest level that we've seen in 3 decades. And so, the Fed has definitely used this development and persistent, wage growth is really the catalyst for signaling for earlier liftoff to tighten monetary policy. And so, the good news is that both U.S. and global consumers alike are really in good shape. That should support the economic expansion this year. We expect GDP growth, globally to be closer to 5% than 6% as it was last year, and GDP to moderate a bit, here in 2022. Closer to 2% towards the end of the year, but likely closer to 3% for the aggregate, which is obviously down quite a bit from the last couple of years. And so, I guess the big takeaway is higher wages flow through in the prices. We expect goods-related supply chain issues to be resolved, as we mentioned earlier, but we also believe that labor force participation, will remain a risk, as the year continues, but should recover, especially as some of the financial cushions and COVID-19 risks subside. Again, the bad news is the labor market ultimately could pick up the baton, for the inflationary risks, from the temporary demand and supply imbalances. And so, again, I think in summary, the path forward will not be really the most smooth one, potentially, going back to the Plinko analogy. But, the problem for the Fed is that, looking at their operating framework, it ties their credibility to healing the labor markets instead of fighting inflation. And the Fed has a dual mandate: full employment, which we're very close to reaching already, as well as price stability, which we're far from reaching, and it's been a very big problem for the Fed. And so this inflation-driven policy error could happen before they can react to it. And they're also facing political pressure from both sides of the aisle, especially in a midterm election year, and could certainly find plenty of supply side reasons to remain accommodative. And so again, I think one of the biggest risks this year is a Fed misstep and an overreaction to some of the inflation and amid a slowing economy. Again, not in free fall, but slower in absolute and relative terms.
So given everything we've talked about this morning, I think it'd be helpful to end with some of the highlights of the team's view and maybe the outlook for the year ahead before we get into the questions from the audience. So I'll let you talk about that.
Yeah, sure, Chris. And we've touched on it already, but and maybe I'm beating a dead horse here, but while inflation risks rather than growth expectations have driven the recent pivot from the Fed, we do expect that growth, as I sort of mentioned just earlier, growth will remain above trend, but will moderate this year. Again, we'll still see, likely strong GDP growth coming in near 3% here in the United States, closer to 5% across the entire global economy. And that's direct result of, fading expectations for fiscal stimulus. But we also have been seeing estimates, lower themselves for, first quarter GDP already, as we've gone through just a couple of weeks here in January, which could lead to lower estimates, throughout the year as well as the global economy deals with the Omicron variant. And so, ultimately, I think we'll see growth continue to slide closer to the levels that we saw prior in the previous economic cycle, near 2% year-over-year GDP growth as the year comes to a close. But, overall in aggregate, I think the U.S. economy will have a very strong year. Again, labor market and U.S. consumer, 2/3 of the economy, and they're in really fantastic shape right now. Obviously, this is very supportive for the global stock market, with the expectation that profits will continue to grow, at least here in the United States, in the mid to high single digits, with returns potentially to follow. Unlike prior years where the market has benefited from multiple expansion, so that is, the PE ratio going from 20 to 22, for example, we really think this year will, like last year, largely be driven by profit growth. And so just, companies obviously making more money simply, which, certainly could be threatened by wage growth and higher input prices persisting later this year. Again, similar to 2021, we actually saw market multiples or market valuations come in, despite, seeing, again, a record year for the stock market. And again, that had been driven from profit growth, which really outperformed analyst expectations over the course of the year. Profit margins are currently standing about 12.3% versus 11% before the pandemic. And so, as we've heard from clients concerned about why the market has gone up so much, part of it has been, where interest rates are and just there are no other alternatives, or TINA, as the financial media likes to say. But the other big piece has been profits have actually really grown over the course of the last 2 years. And again, a lot of that may be very different from Main Street, but as we look at the concentration, especially within the technology sector and healthcare within the indices, obviously those are areas that have actually benefited quite a bit from the global pandemic. Company commentary from the third quarter continues to suggest that companies were able to leverage their pricing power and pass on price increases to consumers. And this will be a very, very important thing to watch for, especially if you manage money outside of the assets that we work with you on, because there are going to be certain companies and sectors and industry groups that are going to be more susceptible to rising input costs, putting risk to their profit margins and therefore upside for the remainder of the year. Within the bond market, despite rising rates, we're obviously encouraging our clients to not discount the value of bonds as a diversifier and a store of value long term, providing protection and ballast should economic projections fall short. And we believe rate hikes expected later this year really have already been priced into the market, especially the last 2 weeks we've seen here in a pretty significant move here in U.S. rates. But keep in mind that here in the United States, the U.S. fixed income markets remain both a safe haven for global investors, due to a high number of quality U.S. corporations that are issuing debt, but also the U.S. Treasury market remains in high demand, especially as you look outside the U.S. and the developed world, especially in Europe, where yields are much lower. And so despite credit spreads, reaching, record lows, we still favor corporates in this environment, but we expect more of a coupon clipping year with a source of return for the fixed income market or bonds to largely come from the income that's generated as opposed to price appreciation, which will only take place if the expectations for rates are actually lower. As I mentioned earlier, we expect inflation getting under control, and while year-over-year headline numbers will still be startling, one important thing to focus on and continue to focus on is month-over-month changes. Again, for example, December CPI was up about 0.5% month-over-month, but November CPI was up 0.8% month-over-month. And so, we expect the international shipping networks and workforce participation to loosen up and really straighten out some of the supply-demand equation. At the same time, a shift of purchases from goods, Americans were buying at record levels when we're all stuck at home, to the services like travel, leisure, and even dry cleaners and hair salons should put a more sustainable path to the historically elevated but manageable inflation to closer to that 2 to 3% range. For companies, I think these dynamics may offer opportunity to make price increases permanent, further bolstering their bottom line. And I see a question here actually, related to inflation being a one-time step up, and it's saying, do you mean that cost of housing, rentals, and other living costs will step up and recede the previous levels, or is this a new level and will hold there? And one of the, I guess, actually tailwinds for the U.S. stock market or global stock market is that we actually don't see companies reduce prices again. And so it'll very much, I think, to be industry specific, sector specific. Obviously, the competitive landscape is very different, from industry to sector and so on. And so, we could see, I guess to answer your question, I think, housing, for example, is probably a good one. I highly doubt that we'll see, I guess, rents, go down. For example, however, for companies that say are manufacturing or providing, say, software, if they increase prices by 4 or 5% in last year, unless there's extreme competitive pressures, I don't see them actually cutting prices in the coming year. And so ultimately, as their costs begin to either decrease or not nearly grow as much, they could fall straight to the bottom line. And so certainly could be a nice tailwind for the U.S. stock market. Moving on to Washington, my least favorite topic, and always a source of market uncertainty. Every day we see it. At least not right now. We were actually in a blackout period of Fed governors speaking, but we've seen certainly Fed governors spook the markets. We don't necessarily see a prediction for doom or gloom to come. It is an election year. The Fed traditionally uses some of the commentary that they make in the media as a bully pulpit to drive behavioral change without actually having to change Fed policy. So keep that in mind as you hear Fed officials speak. But the key risk in our mind is the Fed either takes too long to act and ends up slowing the economy after it's already slowed, and just overreacting to these inflation risks that we've seen really bubble up over the last couple of years. From a legislative perspective, it looks like the Biden stimulus proposals are dead on arrival, which I guess turns our attention to the midterm elections. Traditionally, the markets like gridlock and they like certainty, and so what remains to be seen, we'll have some volatility later this year. And finally, monitoring the plateau and hopefully drop off in Omicron cases, understanding there is a lag effect to hospitalizations and death, but it certainly seems like this variant is far less lethal than others. And as we likely transition or hopefully transition into the endemic phase, where COVID greets us each winter like the flu, we need to have tools to manage outcomes with vaccines and therapeutics. And so, fortunately, we've seen schools and daycares, move to being fully open, which is, one obviously key to expanding labor force participation. But as Omicron has shown, even, other less, lethal variants create disruption to the economy here in the short term. And so we'll be watching for that as well. But I guess in summary, this outlook is really the midpoint for the variety of possible outcomes this year. It is important to know that we'll likely get many ups and downs and provide opportunities and challenges as we go. And most important thing is a diversified portfolio, rebalancing when appropriate. Our approach tries to find a middle path in balancing risk reward. And economies and markets generally do not move in a straight manner. It's more likely we'll see some challenges in some areas and some great outcomes in some others. And so, either way, our approach to diversification and rebalancing will likely soften some of the edges of what could be a potential volatile landscape. But please, know that we're certainly keeping very close tabs on the situation and ultimately positioning, your portfolios in a way that we think is prudent, given these risks and also opportunities in the landscape as we look ahead. So I think that's it for the questions, Chris. I'm not sure if you want to take a look at Q&A.
Yeah, so the one you kind of touched on with housing market, and then there's another question about specific sectors and say energy-related equities, things like that. So I think we can take more of the specifics offline, but you kind of touched on it. Having a diversified portfolio, so not necessarily focusing on any one sector, but having a good diversification in there, right?
Yeah, that's exactly it. As I like to say, like you're always, with having a diversified portfolio, you're always apologizing for something. And I think that's the most important thing about diversification is having that balance. Energy is a perfect example of that, being one of the laggards of 2020, down, over 30%, but ultimately being the most, the strongest performing sector, last year. And it's very difficult to time these things. Ultimately we will impose, our view as an investment committee, I guess, and try to take advantage of some of these opportunities when, we do see, mispricings that take place, or maybe the market overreacts one way or the other. But, diversification is really important, obviously. And going back to that financial plan, which I'm sure you could share on.
Yeah. And we'll get to that. Luckily that I'm a wealth advisor and I have some clients, they ask some questions ahead of time. One of the questions here are risks. What are the risks if conflict occurs in the Ukraine? And I think that kind of folds into one of the other questions I had, which are, if you could sort of summarize of what are three key risks that you see for the stock market, and if it's geopolitical, if it's conflict, if that's one of them, but what your thoughts and what the investment committee's thoughts are, sort of the key risks for the stock market.
Sure. Yeah, and I think it'll be largely a summary of some of our prepared remarks. I think first and foremost, inflation will remain a risk, and seeing the labor market dynamics over the course of the next 12 months will be so important to understand whether this wage growth ultimately continues and really puts pressure on profit margins for companies. And so, we're expecting a strong year, for profits and the continuation that we've seen the last 2 years from a growth perspective. But if we do see, rising input costs linger longer, if we see wage growth continue to take a bigger bite out of corporate earnings, and companies being, less confident that they can pass rising prices, on to us consumers, then we definitely will see, I think, some volatility within the stock market, and I think that's one of the major risks of this year. I guess similarly, the Fed and how they respond is definitely a risk, and just having a policy misstep. I think I mentioned, monetary policy is a social science, and economics is a social science, and monetary policy is not exact. And so, seeing the Fed, from, I guess, our perspective, being a little late in tightening monetary policy, I think hindsight is 20/20, but the sheer volume and size and scope of stimulus over the last, I'd say, 6 to 9 months, in particular related to quantitative easing, could have potentially been avoided, and we could have started, moving closer to tightening a bit sooner. But now that the Fed, obviously is pivoting, and I think making a smart decision related to how they'd like to hopefully combat inflation, I worry now as, some of the fiscal stimulus is wearing off. We're not getting, or U.S. consumers rather are not getting, record levels of PPP funds or other stimulus checks in the mail. Demand certainly weakening. We've seen, PMI numbers come in a little bit. The Chinese economy worries me, given, some of the risks I mentioned earlier, and how that could contribute to, a bit of a global slowdown. And so, again, I think, Fed policy misstep is really the big second one. And I think that the third, I'd argue, is, I think I pretty much covered them all. I'd say, geopolitics more broadly. You mentioned the conflict in potentially the Ukraine. Ultimately, geopolitics are very much the most difficult thing to try to handicap and calculate, into the equation, especially given that, most of them ultimately are remediated very quickly. It causes the market to, be quite volatile here in the short term. And I'm not saying this is always the case, but tends to be a pretty wonderful buying opportunity. But you have to look at contribution to global GDP, and it's not to, knock on Ukraine or any other, country that, is facing geopolitical issues right now. But, if it's an idiosyncratic issue and it's a country-specific issue, and it's a relatively slow, small contributor to global GDP, then, the market tends to look past it, fairly easily, and is really rational when it comes to these things. So, again, there's not to, play down, the potential risks, but, geopolitics, risks are always present and very hard to predict, and again, generally create, a lot of volatility for not much,
Yeah, and another question came in, and again, it's more focused on sectors and commodities, things like that. But I guess it brings up a question that I have, and it's with a lot of the technology or growth stocks that we have in our portfolio. And in the beginning of this year, at least, as interest rates are rising, you see sort of the growth stocks selling off, the NASDAQ. What are your thoughts there? And I guess if there are any sectors that you think might perform a little better at this point, or where you see sort of our growth portfolio going?
Yeah, great question. So first and foremost, I'll get into some other sector dynamics here in a second, but you have to realize that, every financial instrument or security is, being priced in a very similar way, and analysts and market participants are trying to value these investments by using a discount rate to, discount future cash flows. And so, in the case of a bond, those cash flows are coupon payments, and in the case of a company, those cash flows could be, we use, operating profits, it could be earnings, it could be, other, cash flow variations. And so we're discounting those, back to today using a discount rate. And so as that discount rate goes up or down, it's going to make stocks more or less attractive. And so growth-oriented companies tend to trade at higher multiples and higher valuations than more, say, cyclical or value-oriented stocks. And as the outlook for the global economy improves, and the expectation that a lot of the cyclical companies and those that are going to benefit most from an economic expansion tend to, market participants expected to benefit from that. There certainly will be some impact, obviously, to the valuation from the discount rate. But being that analysts and market participants are expecting that revenues and profits will potentially grow more quickly than previously expected, those tend to be some of the sectors and styles of companies that outperform, during an environment. And we saw that, we've seen it so far this year. We saw it for the bulk of 2021. However, growth stocks are more, companies that are, say, less sensitive to economic expansion and contraction. A good example would be some of the largest participants within the S&P 500 that really, as the economy continues to expand and let's say, growth exceeds all of our wildest expectations this year, their growth is not going to be necessarily, tied as closely to, the economy as much as, say, a construction company or a cement, company would be. And so in an environment where, obviously growth is higher than trend, we would expect some of those cyclical companies to potentially outperform growth-oriented companies. But I think it's really important, and this is how we're positioned as a firm, to really balance these sectors and these exposures within a portfolio, given the uncertain landscape that we're faced with. And, going back to, my comments earlier, a lot of positive growth news has already been priced into the market. Market participants are expecting growth to slow later this year. And so while I could see some of these more cyclical-oriented sectors or industry groups continue to perform and outperform, say, some of the more growth-oriented ones within the next 3 to 6 months, our view in the long term is that growth will moderate, and there is a tremendous amount of disruption and I think, growth potential, no pun intended, within some of these growth stocks that, again, are not going to be nearly as sensitive to economic expansion. And so I know that was a bit of a complicated or technical answer, but I hope I addressed, I think, some of the questions there related to just the dynamics that have impacted, rising rates ultimately being more of a sensitive contributor to, growth-oriented stocks due to that discount rate, but also investors favoring businesses that will benefit in an environment where growth is higher. And if you really, I guess this is the last wonky thing I'll say today, hopefully, but there's a significant correlation between value stocks that are more cyclical and the shape of the yield curve and the steepness of it. And so, again, we've seen bank stocks perform extremely well recently. But, if we start to see, the Fed raise rates on the short end, yield curve could potentially flatten a little bit as growth starts to slow. And I guess you get my drift as to, what my views are on what sectors would be outperforming at that point in time. So.
And I guess I have a lot of questions that come up about cash, right? Either clients have a lot of cash outside of the accounts we manage, or there are some cash balances in the accounts we manage as well. If you had a significant amount of cash, what do you think you should be doing with it right now as far as the markets are concerned and investment?
Yeah, it's the age-old question. And I think it would probably be helpful if we, give maybe two answers, one that's more market-oriented and one that's a bit more financial planning-oriented. But, on the market side of things, I was looking at some data recently, and the equity markets or stock market, tends to trade actually near all-time highs a large portion of the time. And so if you actually look back, to 1945 through the close of, 2021, 60% of the time, the market is trading within 10% of its all-time high, and about 10% of the time, it's trading at an all-time high. And so, I guess my point is that investors should not be particularly concerned about investing when maybe markets are near all-time highs, given the risk, especially now that's even more elevated due to inflation, that missing out on, continued market performance, obviously would cost you by, sitting on the sidelines. And so I think last year we saw something like 39 all-time highs. I remember, going back to 2016 when this was an argument, very loudly, from clients. I think we saw something like 42 all-time highs. And so all-time highs, I guess my point is, they do not foreshadow low returns or bear markets. And if you look at multi-year returns on a 3-year period when markets are at all-time highs versus, say, 10% off all-time highs, they're almost exactly at 10%, which is the annualized return of the S&P 500 going back to the 1800s. And so, and it really is driven by profit growth at the end of the day. I mean, that's why we spend the time that we do talking about the fundamentals of the economy and how that could potentially translate to corporate earnings and therefore the stock market over the long term. And so, while on a week-by-week or day-by-day basis, fundamentals are really not driving the market too much. It's more the noise and the momentum and the algorithmic traders. In the long run, we believe the economy and ultimately fundamentals will drive stock prices. And so, again, if that's your view also, I think it's very difficult to, time the market, with putting cash to work. And so, if you think about historically pullbacks, of 5 to 15%, they occur nearly every single year, and recoveries tend to be very fast. Historically, the probability of a 5% or larger pullback is about 50%. And right now in the NASDAQ, Russell 2000, MSCI Emerging Market Index, as well as the MSCI EAFE, I think we've now pulled back in excess of 5%. The S&P 500 is very close. And so I guess my point is, the investor, will not gain an appreciable better entry point about half of the time. And it just goes to show you the odds being stacked against you and trying to time the market. And so, I think for clients, obviously it goes back to financial plan, and I'm sure you'll touch on that a little bit, but I find a very helpful solution to have really what we call a dollar cost averaging process is, based upon your plan, set aside a dollar amount that you feel comfortable investing. And, every single month or every couple of weeks, go in and make an allocation just as you would, potentially to, a corporate retirement plan, and take the emotion out of it. Let us pick and choose where it's best to place during an environment like that. And if we see more significant correction, obviously we may speed up the the cadence of how quickly or maybe go fully invested with all the cash, but it's so difficult at the time in the market. And obviously we encourage clients to focus on their financial plan and what achieving those rates of returns means to you long-term, as opposed to, trying to maybe, avoid a 5% pullback, which is, almost inevitable.
Yeah, and I think that's where
absolutely inevitable. Yeah. Sorry.
And I think that's where you had said financial planning. I think that's where it really is important to look at, how long this money has to last, right? What your investing time frame is, when you're going to need this money. And, if it's 10, 15, 20 years from now, you're better off getting into the market. Like you said, if you want a dollar cost average, but it's important to look at your plan and say, I need this money. Do I need this money to work for me? So if there's, in the next 6 months, you need a significant amount of money for something, maybe you're building a house, sure, yeah, keep that aside. Or if you feel comfortable having a certain amount for the next 3 to 6 months of expenses, which, that's what the books say, do that. But for the rest of it, depending on your time frame, that's where asset allocation is important, doing the financial plan and revisiting that financial plan as you get older and as your situation changes.
Yeah, you hit the nail on the head. And just taking a look, let's say, a $100,000 investment in the last year, had you invested just entirely in the S&P 500, you'd be up about $25,000. But, that purchasing power, because of inflation being about 7% year over year, obviously, is, not lost to you at $7,000 on paper, but, basically eroded your purchasing power. And that delta is $32,000. And, as that $32,000 delta, compounds over, the rest of your life, 10, 20, 30, 40 years, and you're looking at a stock market chart, well into retirement or 10, 20 years from now, what we are today, unfortunately, is a little blip on that chart. And I don't think, it will, I'd say, I hope you won't lose sleep at night, by starting to allocate some of that cash. And if you are, then maybe you take a look at your asset allocation mix. Perhaps you're taking too much risk on within your portfolio, and that needs to be addressed to the financial plan and some other exercises we can go through with you.
Yeah, and I think it's a good time, especially in the beginning of the year, to sort of reassess everything and look at, okay, what my time frame is, what my allocation, and has my risk preference changed? So it's a good conversation to have with your advisor. All right, so with that, I think we're going to wrap up the call today. We appreciate you all taking the time to join. We thank you for submitting questions, and we hope you continue to find this helpful and informative. Again, the presentation will be up probably within the week. Be sure to visit our website, meetgirard.com. And until next time, please stay safe, stay healthy, and let us know if we can help in any way. Take care, everyone. Thanks for joining.